Welcome again to our 2025 halftime report, the all-new risk. I am Matt Jenskow, investment strategist here at Waddell and Associates, and it's my pleasure to kick off the live session today. We appreciate you carving time out of your day to be here with us. Today's featured speaker, David Waddell, our CEO and Chief Investment Strategist, is a leading voice in economics and investment strategy with over 20 years of experience. He's a regular contributor on CNBC, Bloomberg, Fox Business, and more. Today, David will revisit his annual forecast from earlier this year and walk us through some of the important forces shaping the landscape today, including the current market environment, macro environment, policy developments, and trends to watch in the back half of 2025. Couple of housekeeping items. If you missed our Outlook 2025 presentation earlier this year, you can find the full recording on our website at www.wealthstrategists.com. And if this is your first time joining us, welcome. Waddell & Associates is a wealth strategy firm committed to enriching lives by providing clarity. Throughout today's session, if you do have questions, you can submit them using the Q&A feature on Zoom. David and I will address as many as time will allow at the end of today's presentation. And for anything we don't get to, we'll be sure and follow up. We are recording today's session, so a replay link will be sent out in the next couple of days and will also be made available on our website. And with that, I will get out of the way. Please enjoy the 2025 halftime report, the all-new risk. David, it's all yours.
Excellent. Good morning, everyone, and thank you for clicking in to this, our halftime report. 2025 has been quite a rodeo ride, so much so that we've actually had two updates, including this one, in addition to our 2025 outlook that Matt just mentioned. By the way, thanks for that intro, Matt. Excellent job. So we're going to take a look forward today, but we're also going to take a look backwards and review the two presentations that we made to help us get some context to where we are and also help us set the groundwork for what I am calling the all-new risk, which is a teaser. And so therefore, I will leave the reveal until towards the end of the presentation, hoping to capture your attention. So with that, let's take a look back. We titled our presentation, our Outlook presentation this year, That's the Spirit, to sort of capture our sense that animal spirits were running wild coming into 2025, that expectations from economists, from investors and consumers were all crescendoing, and that created on its own a unique set of risks. And just to make that more specific, as we entered 2025, retail investors had their highest return expectations in the coming year ever, with a full 60% of them, typically a pessimistic group, believing the markets would be higher over the next 12 months. Record high confidence from retail investors. We also saw record high confidence from professional investors or institutional investors as well. In fact, the amount of cash that they were carrying within their portfolios was as a record low as we entered into the year. And the bond market shared the enthusiasm for the economy and also for the credit quality of the companies and the sovereigns with which they track. This is a chart showing U.S. investment grade and credit spreads and high yield credit spreads. And as you could see, they were really close to record lows entering the year. So it wasn't just retail investors and institutional stock market investors who were bullish in 2025, it was the bond market as well. And when you mix those all together, the typical Wall Street strategist became highly bullish as we entered the year. In fact, the median target for the S&P, which closed the previous year at 5887 or 5787, one of those. Anyway, below 6,000, predicted that we would have a median return on the year of 6,600, meaning Wall Street strategists were predicting for 2025 a 12% gain. Now recognize in 2023, they were predicting basically no gain. In 2024, they were predicting basically no gain, and we got 25% gains in each of those years. And so it's not atypical for strategists to be a lagging indicator, but nonetheless, coming into 2025, they were very, very bullish. And that gave us a little sense of concern, knowing that entering the third year of a bull market, returns tend to be a little bit more muted. So we've shared this chart with you a couple of times, but I do think it sets the table for where we are in this bull market cycle. The cycle began October of 2022, and in the typical first year of a bull market, markets will rise, call it 36% on average. This market rose about 18% on average, a little below historical norms. Entering the second year, bull markets typically rise about 20%. In the second year of this bull market, caught up to the trend line, went up about 40%. And in the third year of a typical bull market, they tend to digest the outside gains of the first 2 years, rising only about 8%. And as we entered 2025, we were actually a little bit above the trend line, making us cautious on the year, taking the under compared to the typical Wall Street strategist and saying, why don't y'all just take the year off? That didn't mean sell, it just meant relax a little bit and temper your enthusiasm. Well, the reasons beyond that why we were somewhat concerned about the return trajectory for the markets is that we had a preview in Trump 1.0 of what tariff wars look like within the space of the stock market. So the first trade war began, call it early 2018, and ended in late 2019. During that period, the S&P 500, as you can see on your screen, basically trended sideways. In fact, at the end of 2018, we had a very near bear market scenario as tensions with China over tariffs rapidly increased. But over that entire time frame, which is basically an 18-month period, the stock market really only rose a meager 3.6%, further reinforcing our somewhat tepid expectations for stock market returns in 2025. And we were also a bit concerned because the stock market is very concentrated, which we'll revisit again, and the Mag 7 could become the Lag 7 in our opinion because 53% of revenues for the Magnificent Seven companies come from offshore payers. And in the middle of a trade war, we thought it could be that Japan, the European Union, perhaps China, would victimize the most notable United States corporations in the midst of a Trump-initiated trade war. And so we felt like that could also be a catalyst for some meager returns on the year. But we also noted that this bull market, which again began in October of 2022, is still young and still short. So here are the bull markets going back to 1950 in terms of duration and also magnitude. And this is where we began the year. The bull market was up about 70%, and it was about 26 months old, which is pretty young and pretty short for comparative bull market returns. Furthermore, while year 1 and year 2 returns may be quite robust, year 3 tend to lag, as we showed, but then revive in year 4 and year 5 to show more robust returns for investors as we get closer to the end of the full market cycle. So we had somewhat meager expectations for returns coming into the year, but we recommended that you do not fold and you try and participate in markets in ways that you can make some money without getting burned. And as we went into pre-Liberation Day, our forecasts were basically right on point. So markets did hit new highs into February 19th, and then we had the DeepSeek scare. Remember, the Chinese said they could do basically what ChatGPT does at cents on the dollar. And that put a little bit of fright into the Mag 7 complex, which again was priced to perfection. That dragged the market lower, and then we traded sideways into April 2nd in anticipation of Liberation Day, but pretty close to the flat line, which is kind of what we expected for the course of the market on the year. And really, so everything was kind of going to plan, while not, fantastic from a return standpoint. I'd rather know why the market's doing something and be ready for it than be surprised. Well, unfortunately, we got surprised. So on Liberation Day, also kind of Liquidation Day, April 2nd, Trump surprised all of us. in the Rose Garden with a slate of tariffs that averaged out to about 3x what Wall Street was expecting and created a sequence of volatile events. And this chaos and confusion of Trump 2.0 was really stemmed in the following. Were these tariffs really about reindustrializing America? There were plenty of memes about, do we really want to go back and make iPhones in the factories and wear hazmat suits and semiconductor plants? Do we really want to reindustrialize? And then are we really doing this just to reduce the deficit? We talked at length about that. Could the offsetting tariff revenue maybe, pave the way for the passage of the Trump tax cuts? Unclear. And then were we really just doing this to renegotiate trade deals so that the starting tariff level would actually be much higher than the ending tariff level? Because what Trump was really trying to do was erase tariffs, not increase tariffs. And with all of this confusion, it led the Economic Policy Uncertainty Index to an all-time high. So the confusion in the marketplace was higher actually than the Great Financial Crisis, and it was higher actually than the COVID pandemic. A very uncertain time. And as you know, as students of the markets do not like uncertainty. That immediately dragged the S&P down towards bear market territory, down 19% or so into mid-April. And for the Mag 7 that we worried would be the Lag 7, indeed they were, dragging the returns for that complex down nearly 30%. And strategists caught religion on this as well, immediately became more pessimistic. As I said, they tend to be somewhat backward looking. We try and be forward looking. Nonetheless, they cut their expected median return target to 59.67 on the year with an expected gain of 1.5%. And so slashed expectations significantly. And that led us to quickly stand up a live strategic weekly presentation, which we titled The Trump Tariff Two-Step. Given all of the chaos being generated by Trump's tariff negotiation tactics, we thought better to get in front of our clients and friends and talk about our perspectives on what we thought he was trying to accomplish and what we anticipated for the market going forward. So we stood this up in mid-April. Couple of things we noted. Number one, this is the fear index in the market. Just as volatility hit all-time highs, the fear index climbed up there pretty closely as well. So this chronicles movements in the VIX index. Again, the fear index, you can see the Liberation Day surge above 50 was matched only by what we saw in the Great Financial Crisis and only by what we saw in COVID, making us go back and say, what happens to stock market returns after peaks in the VIX like this? What we found is during typical VIX scenarios, the market's 12% higher 1 year, 25% higher 2 years later, 39%, 3, and then 5 years later, the market's 75% higher. That's typical market movement. After moments when the VIX spikes as high as it did above 50, returns actually are so much better. So 1 year later, on average, the S&P is up 36%, 3 years later, up 58%, and a full 5 years later, more than double, up 133%. So maximum fear tends to drive maximum returns. And on cue, we had the third largest one-day rally since World War II on April 9th. And I had a front row seat for that on Power Lunch that day, CNBC headquarters. And I have to tell you, that is the most fun I've ever had in TV land, watching that market bounce 10% while sitting on the CNBC desk. So this was anticipated, but also pretty dramatic. So then we went back and looked at periods of time after you have dramatic single-day gains like that in the index and said, what do returns look like 1 year later, 3 years later, 5 years later? You'll have to trust me. On average, after looking at the top 15 one-day gains, 1 year later, market's up 38% on average. 3 years later, I think it's 58, and then 5 years later, about 125%. So from a maximum point of fear, markets typically do well in the future. From a massive one-day gain, markets typically do well in the future, giving us somewhat of a bullish stance as we reported in mid-April. headed forward. And fortunately, that is exactly what happened going into the end of the first half. So post-Liberation Day, markets collapsed. And then we got some relief from Trump, and I'll spend a little bit more time on that. And markets went on to reclaim all-time highs by the end of the first half. And in fact, the ascent from the lows reached April 9th or April 8th, I guess, were some of the fastest gains that we've ever seen in market history. So it was really a control-alt reset for the S&P 500 index. So overall, here's what the halftime returns looked like. Gold actually outperformed and ended up 24% higher, gold being seen as a safe haven for tumultuous times. And whether it's up, whether it's down, the first half was definitely tumultuous. We saw international stocks return about 20%. A couple of components to this. Number one, a declining dollar means currency appreciation for shares held overseas. So roughly 11% of that can be explained just by currency depreciation, which you see on the right-hand side of your screen. And then the remainder really came from the fact that Trump went out and told these offshore economies, number one, you need to get your own economy. And that unlocked stimulus in Europe specifically, also a little bit in China and some in Japan. And number two, they said you really need to get your own military. And so now we're seeing spending in Europe and Great Britain and other places rise much faster than it has in the past. And so that helped boost expectations offshore to match the improvement seen benefiting from the lower dollar here. So emerging markets and international markets performed rather well. S&P was up 6%, the tech-heavy NASDAQ up around 6% as well. Commodities did fine, up about 5% as the dollar declines. Usually that helps commodity prices go higher. And then the Dow Jones Industrials about 4.5%. Bonds got you 4% in the first half. Real estate about 3.5%. The Mag 7 did lag in the first half, up about 2% in comparison again with the S&P up about 6%. Small caps ran off the bottom, but didn't quite recapture that zero line as recession fears continued to sort of percolate going into the end of the half. And as I said, the US dollar was down about 11%. So overall, a very profitable first half for investors, and at 6%, pretty much in line with kind of what we thought from a year three set of returns. It was just a wild ride to get there. All right, so that's looking back. Let's go ahead and look forward, and we'll dig into some details that'll lead up to the reveal on what I think the all-new risk is for this market. All right, first of all, we can't talk about investments or economics without talking about Donald Trump, since he has taken the central casting conductor role for the entire economic complex. Now, coming into the year, we expected that the overall U.S. tariff rate would rise from the 2.5% prior to January 2025, maybe 10% more, to about 12%, which is significant jarring, led to a lot of concerns, almost as high as we saw during Smoot-Hawley. But that's what we expected and thought the market would digest it, maybe trend the year sideways. The current rate reality is that we're really kind of at a weighted average of, call it 16.5. So a little bit above what we expected, and tends to be harmonizing somewhere near that rate as I speak. Now, tariff rates are definitely a problem in some regards, but at 28%, which they were peaked at right after Liberation Day, they were a real problem, a real concern seen in the market slides we just revealed. But the market cares more about trends than it does absolute levels. And so if you just consider that Trump peak tariff happened in mid-April at 28%, we've actually fallen 12% since then. So tariff rates have been going down. For those of you who follow our commentary, you'll know that as we looked past early April, we figured that he would end up cutting tariffs, and the trend is really what the market cares about. Like I said, not the absolute level. So tariffs have actually fallen 12% since right around the moment that he escalated the tariffs on the Chinese to 28%. And now we've got a whole slate of done deals. Love Donald Trump, hate Donald Trump. I can't understand the style for sure, but it has been pretty productive. So we have reached agreements, although they're not in ink, with the United Kingdom. China, it sounds like we're going to go ahead and kick that can down the road a little bit further. That's okay. Although Bessent came out and said he felt really good about where we are with China overnight. Vietnam, we got that deal done. The European Union, not only did we get a 15% on most EU imports, but we also got them to commit to buy $750 billion worth of energy and invest $600 billion in the US. Japan, 15% as well, and they agreed to buy $550 billion worth of stuff from the US, mostly in loans, by the way. That's kind of interesting. But nonetheless, guaranteeing the loans, buying some stuff. And then we've inked deals with the Philippines, Indonesia. We remain undone with Canada and Mexico. Canada doesn't look great, but something will come. And there's no tariff rate right now on the USMCA goods, which is the vast majority of trade between us, Mexico, and Canada. And I believe last night we also got deals done with South Korea, with Cambodia, and with Thailand. So great progress has been made on these done deals, and indeed revealed that it's a little bit of each of those three bubbles: reindustrialization, reducing the deficit, and also renegotiating our terms. So there have been several deals done. Now, what does that mean for tariff revenues overall? So this is the tariff revenue, US monthly tariffs going back to 2012 or something like that. And you can see prior to Trump 1.0, we were bringing in about $3 billion in tariffs a month. Trump obviously waged much larger tariffs, getting us up to almost collections of $10 billion a month. Biden kept the tariffs on, by the way, and then some of them expired and he carved out some exclusions, and then a lot of production moved away from the most highly tariffed nation of China. And so that trended tariff stack down a little bit. But you can see, obviously, there's been a spike higher in real tariff revenue since Trump begins his second term, to the point where this month we'll probably be at 28 billion in tariff revenue. We were at 27 billion last month. And that makes your Treasury Secretary, Bessent, very, very happy. And in fact, at a press conference in Latin America not long ago, Bessent said tariff revenues in 2025 should be expected to be north of 300 billion. So quick work with a spreadsheet will tell you that if we started collecting tariff revenue in May, June, July, and you can figure out what it would take for the remainder of the year to get us to call it 350 billion in revenue, then he signaled, we picked this up, I think, and put it in our email a couple of weeks ago, that the universal tariff rate Trump's really driving towards is about 15%. And indeed, that's the level that he tariffed Japan, EU, and South Korea with. And so we'll see where things ultimately settle out, but 15% seems to be the new universal tariff rate that Trump is targeting. All right, now, a tariff is a tax. And a tax of 15%, $350, $400 billion on a $30 trillion economy is relevant. And it led economists at the beginning of the year to talk a bit about stagflation being this awful and mystical creature last seen in the 70s, where you have slow growth paired with inflation, none of which is good for quality of life measures within an economy. And so you'll see in the papers today, there's more conversation around stagflation. So let's review how real stagflation is and how big a threat we think it will be going forward. Let's start first with the stag side, or the growth side of the equation. All right, here's the GDP setup. Remember that according to the Congressional Budget Office, according to the US Federal Reserve, potential GDP growth quarterly, annualized, for the United States of America is about 1.8%. So if we're above 1.8%, we're growing above potential. If we're below 1.8%, we're growing below potential. Well, over the past couple of years, we've been growing above potential, which has been great. Consumers been strong, inflation's come down, real GDP has maintained kind of a 2.5% level until we get to the first quarter of 2025, the first quarter of sort of the Trump administration, and GDP actually fell down 0.5%. So for those economists who had been crying recession for quite a while, this was rather validating. They just need one more quarter, of course, to coin a recession as an actual event. But when we dig into what happened in the first quarter, that negative 0.5% GDP print was really a consequence of the fact that GDP stands for gross domestic product. And what happened was people imported a whole bunch of stuff offshore to stockpile ahead of potential tariffs, which ends up being an import and therefore a detractor from GDP growth overall. So growth was down 0.5%, but the consumer spent money, the government spent money, companies spent money, inventories rose. And so there were offsets to that massive import figure, which dragged GDP down 4.6%. So if that's the case, we better take a hard look at whether this economy is contemplating recession. If we look at the unemployment rate, we're right at 4.1%. We'll get another report tomorrow. 4.1% is basically an economy that's operating at full employment. And while it's ticked up slightly from the low we reached at about 3.5, it's been hovering at 4.1 and in fact ticked down in the previous month. So the unemployment market, at least from an unemployment rate standpoint, which is backward looking, doesn't signal anything recessionary. And then this is a report we got here just a couple of days ago, the JOLTS report, which is Job Openings and Labor Turnover Survey, for those of you who are technical. And what it showed was that we still have 1 million more jobs that we're trying to fill than we have laborers capable of filling them. So the demand for labor within the US economy right now still exceeds the supply. That is not an environment where you would see an economy tipping into a recession. And because we've got robust labor markets, and because there are still more jobs than workers, that puts upward pressure on wages, and wages ultimately filter through after taxes and inflation to real spending power. And so spending power in the United States is growing right now at about 1.7%. That's a very healthy level. It can support GDP growth, and therefore there is no sign of recession in the labor market or in the spending power of the US consumer. And so the Fed estimates GDP growth with a tool they call, the Atlanta Fed actually does it, GDP Now. And so I went back and kind of looked at the previous GDP Now estimates to try and figure out how accurate they were with the actual GDP reports when they ultimately come in. And here you go. The blue is the estimate. The orange is the real GDP report that we ultimately get. And while, it's not necessarily fully accurate, directionally it's very accurate. So GDP Now did anticipate a negative GDP growth print for the first quarter of 2025. And indeed, we did get that, less than they feared. And so going into the second quarter, had we had a negative GDP growth print, that would have validated the concerns for those who thought this economy was going to tip into recession under threat of tariffs and all of the uncertainties that follow. In reality, that has not occurred. Didn't have time to update this slide. GDP Now had us at 2.4%. Yesterday morning, we got the read on GDP. It was 3%, which is at or above, levels we've seen in quite some time. So there is no sign of recession in the US economy today. All right, let's talk about the inflation side of the stagflation equation. All right, it's important to understand that tariffs on goods that we import from foreign lands really only hit durable goods. It hits soft goods some, it hits energy some, but in reality, the real target is toys and cars and computers and iPhones and furniture. And if you look at things right now, we are seeing inflation uptick. Durable goods price inflation from a year ago period is up about 0.5%. You can see obviously it rose significantly during COVID when we had supply chain issues. And so the tariffs are showing up in inflation, specifically in durable goods. But that durable goods up force, if you look at it over a long period of time, is somewhat benign relative to history. And here's the most important thing to understand, and is the most underreported thing on the tariffs, is that the up force from durable goods of 0.5% really is only about 12% of the entire inflation basket. And durable goods as a size of GDP are about 7.5 to 10% of the size of the economy. So when we're talking about tariffs, when we're talking about tariff inflation, you got to put that in proportion. It's about 12% of inflation in the basket. It's about 10% of the economy in total. Remember, we're a $30 trillion economy, and we import about $3.6 trillion worth of stuff. All right. Now, services, on the other hand, which is largely influenced by housing, which is being deflated right now by high mortgage prices and a lot of inventory. Prices have started coming down on the headline indices. And so it takes a little while, but services inflation has actually printed about 3.4% inflation year over year, yet that is 70% of the entire inflation calculation. So with housing about 35%, consider housing at 35 compared with durable goods at about 12%. And you can see the services side of the US economy has a much more meaningful impact on inflationary statistics than the imported goods side of the economy. So when you put the two together, this is what the Fed sees. So right now, their preferred measure of inflation, PCE inflation, excluding food and energy, is up 2.7% from the year ago period, above the 2% target that they espouse. Powell did take to the hill yesterday. He announced there were no rate cuts. When pressed on whether he would cut rates in September, he said, why would I cut rates in September? We're at full employment and we're seeing inflation well above our 2% target. Talk to me in September. Markets didn't like that, but then got some good earnings reports and came right back. So let's talk about the interest rate reaction to this stagflation complex. If we thought the market or the economy was going to stall, you would see longer term interest rates fall. So the best proxy for the market's expectation for future GDP is really the 10-year Treasury. Right now, the 10-year Treasury at 4.4 is within range of where it's been for, about a year. And then if you're looking for an inflation proxy, you look to the 2-year Treasury and you can see that number has been coming down. So from the stagflation perspective, the Treasury yield curve is telling you growth seems intact, inflation seems, higher than we'd like, but overall pretty benign, mostly because of that services deflation. So I don't see any stagflation really in the mix right now, but there are also some extremely powerful stagflation offsets represented here by the abominable snowman. When you do economics for a living, you end up in some strange thoughts. And so this is the abominable snowman is the offset to the stagflation. And as you'll see in a minute, much larger, much more powerful. Bet on him in a brawl. All right, so number one, we've got monetary stimulus in the pipeline. The US hasn't really started cutting rates yet. We did, back towards the tail end of last year. But if you look at the ECB and the Bank of England, they've been cutting rates. Japan's been somewhat sideways. That's a strange economy. But nonetheless, the path to interest rates is clearly lower worldwide on the short end. And then the other thing that hasn't gotten much attention is that, quantitative tightening measures have been easing, and the US is extinguishing its quantitative tightening program. This has put upward lift on money supply. So money supply has grown 5% year over year. More money, more purchasing, more things, higher stock prices. So an accelerating money supply, falling interest rates, definitely monetary stimulus. And then what has Fed Chair Powell said about it? Well, they asked him, there's difference between an adjustment higher in prices due to tariffs and a pernicious rise higher in prices due to inflation. He sees them as distinctly different. They asked him, would you have cut rates if not for the tariffs? And he said, I think that's right. We're simply taking our time, which irritates Donald Trump, as you know. But if you look at the market expectations for the Fed funds rate, there's 1 to 2 cuts in the market between now and the end of the year, and then maybe 2 to 3 cuts in next year. Nonetheless, trying to get us down from about 4.5% down to maybe 3.25%, 3.5% by this time next year. All right, in terms of currency stimulus, people don't often think of currency depreciation as stimulus, but if that was the case, then why are all these foreign nations pegging their currency low in value compared with the dollar? So currency stimulus is a thing. It lowers the price of U.S. exports for buyers offshore. It also increases the profit translation of offshore earnings for U.S. companies, probably has added 2 to 3% in earnings to this cycle so far. And so Jerome Powell is obviously on the hot seat with Trump. He's now calling him too late. So too late, Jerome Powell is costing our country hundreds of billions of dollars. He's truly one of the dumbest and most destructive people in government, and the Fed board is complicit. That is a man talking down the dollar, which he has said is overvalued, and he's right about that. And in doing so, adding another layer of stimulus to the U.S. economy. Furthermore, Trump has also indicated that he is going to appoint a Fed governor, and that would happen, could happen any day now. But Jerome Powell ends, I think, in June of next year. Hassett, Warsh, Bessent are all up for consideration. All of them would cut rates immediately. There were a couple of board members yesterday who did dissent, both of which were Trump appointees. They wanted rates lower. So Trump is setting up what's called a shadow Fed and doing that to try and bully the interest rate complex lower and also the currency as well. Oh, and by the way, he did pass the biggest tax cut in the history of our country, and that's going to end up bloating deficits. Now, we can talk about whether deficits are good or bad. That's another topic. But if the government's borrowing more money and spending more money, that ends up being stimulus in the economy. How much stimulus? Well, the one big beautiful bill is about $3.5 trillion. Recognize that 2.5 of that was just the extension of the Tax Cuts and Job Act legislation from his previous administration. The remaining 1 trillion is brand new stimulus. And then you're also going to have interest payments likely of about $1 trillion to support that debt. Another reason why he wants cuts from Jerome Powell. As he said, it would save him hundreds of billions of dollars. And so the stimulus is really worth about $4.5 trillion. And remember, we're a $30 trillion economy. So that's a lot of stimulus in the pipeline. And where is that stimulus going to fall? Well, everywhere. It's going to mean more money for you. So here are average changes in after-tax income based upon what Trump has legislated. So if you're in the lowest quintile, you get the lowest increase, but that's because of some of the Medicare shaves. If you're in the top quintile, which most of you are, you get the largest increases. If you make over a couple hundred grand a year, you'll see somewhere between 2.5% and 3.5% or 4.5% increase in your spending power, your after-tax income. And most of that's due to the closely held businesses receiving benefits that flow through to proprietors. But nonetheless, there's going to be more money in your pocket thanks to the one big beautiful bill. And for the economy overall, this is significant stimulus. So in 2025, it'll add about $100 billion in stimulus. In 2026, it'll add almost $300 billion in stimulus. Now remember, we're a $30 trillion economy. That's almost a 1% stimulus. Also happens to be a midterm election year. After that, you can see things taper off. Many of the provisions expire in 2028, and so you can see that the fiscal impulse gets back to more neutral as we go forward from there. So significant stimulus fiscally. And then we have to talk about, because this is what happened after the market closed yesterday, both Microsoft and Meta marked up how much they're spending on their AI capital expenditure build out. If you look at US CapEx, it'll be about $1 trillion this year. It looks to be even more than that next year, which is what the chart on the left says. the amount of capital expenditures going into AI is astounding and will continue to grow. These numbers are too low now based upon the reports that we got yesterday, but we'll get up to $500 billion in spending on data centers and AI CapEx over the next couple of years. This is significant stimulus and accounts for almost 5% of GDP. All right, so if you add together monetary stimulus, currency stimulus, fiscal stimulus, and CapEx stimulus, that's a lot of stimulus in the system, and that should stimulate earnings. This chart shows you analysts' expectation for earnings going through the course of the year, considering what they'd be by year end. You can see by Liberation Day, analysts were pretty bullish. They'd been marking estimates up and then immediately marked estimates down to negative, and then they've steadily been marking estimates higher. For the quarter we're in right now, we anticipated maybe a 5% growth rate. We'll likely get double that. And so if you're looking forward in 2025, call it $264 of earnings for the S&P 500. Over the next couple of years, the combination of monetary stimulus, currency stimulus, fiscal stimulus, CapEx stimulus is going to give us a potential pathway forward of 30% earnings growth over the next couple of years. The market has definitely sniffed that out. And so what could the second half actually look like this year? Well, we went back and looked at previous market years where you had a negative first quarter followed by a double-digit plus second quarter, and asked the question, what are the next two quarters and the second half returns kind of look like? And for the set, we're looking at 68, 80, 2003, 2009, 2020, and now, of course, we're in 2025. So the median across that set was about 8.5% for Q3 returns, about 8.2% for Q4 returns, and second half returns overall of nearly 20%. Now, this is not a prediction, but this is what history shows. In fact, in each one of those years, the third quarter, all of them were positive. The fourth quarter, all of them were positive. And obviously, the second half return, all of them were positive. So this bodes well for strong returns as we go into the back half of the year. Now, here we go for what I'm concerned about, and that is we may be in the midst of the next great melt-up. We talked about a little bit in our outlook, but we tempered our concern around that, being more concerned with the way that Trump's policies were going to be implemented. This chart goes back to 1980 and shows you what the S&P did during that period. And so if you go to about 2005, you can see, or 1995, excuse me, you can see we accelerated higher. Netscape came out in 1994, which would put ChatGPT came out in 2022. So we're kind of at the 3-year mark. If you consider that what's happening with AI is analogous to what happened to the internet when it rolled out. And so that was a portion of time. By 1997, Greenspan talked about irrational exuberance. Now the market went much higher than that over the next 3 years, but there were concerns that the speculative activity was somewhat unjustifiable per Alan Greenspan based upon the fundamentals. So here's where we are now in this cycle, tracking along that curve pretty well. Will we end up having that hockey stick higher? Well, we are seeing some of that speculative behavior. SPACs have taken off again, which are just blind pools of money that are raised to go buy other companies. We saw that in 2021. It didn't end well. You know, maybe this time it ends better. We're also seeing meme stocks show up again, Krispy Kreme, GoPro, Kohl's trading up, substantially. And of course, crypto, can't go down, I guess, because Solana, Ethereum, Bitcoin, they're all rallying again. So there is speculative fervor afoot, and the next great melt-up is growing into what I'm concerned about as the next great risk, because you got to beware the freeze. So after the high was reached in the S&P in March of 2000, the market basically went sideways for the next 13 years. Now, when I say the market, I mean the S&P 500. There were other places to generate returns, but what had been the area of highest enthusiasm ended up being the area of the largest hangover going out over the next decade. So beware the freeze. And so let's look at valuations. Obviously, if you're concerned about where markets are, the measure of how enthusiastic, exuberant investors are will be valuations. Right now, if you look at the Mag 7, which really wasn't a cohort, but more than a decade ago, they're trading at 30 times earnings, which is a little bit higher than that analogous category would have been in 2000. So Mag 7's trading a little bit higher than the top tech stocks back during the internet bubble. That has drawn the S&P 500 valuation up near 23x. That's at or above where we peaked in 2021, and that's only a few points below where we peaked during the dot-com moment in 2000. And this go round, this market is a whole lot more concentrated, which to me makes it a whole lot more vulnerable when you're looking at the S&P 500. So the top 10 companies, a share of total market capitalization, come to about 40%. We were a little bit over 25% back in 2000. So should something go wrong in the top 10, it's going to have a significant impact on what happens in the 500 overall. And if you look at earnings seasons right now, the earnings reactions are becoming a little less forgiving. So here's the average one-day price reaction to earnings announcements over the last 10 years. All reports somewhat benign. If you beat EPS, you got a 2% pop. And then if you missed EPS, maybe a 3.5% pop. Here's where we are this quarter. For all reports, there'd been a little bit of a drawdown. In terms of EPS beats, you're getting rewarded less. For EPS misses, you're getting punished more, about 2% more than average. If you look at Shake Shack or some of the other things today, you can see this on display. So the market has been much less forgiving of earnings misses. So I say, party on. I do think that the stimulus in the system will take this market higher, but I think you can get rewarded without having to concentrate in the names that got us here. So this is trailing PEs. Right now, the S&P's 24, again, pretty close to where we were at the top in 2000. But if you look at mid-cap stocks, I know y'all are tired of me talking about this, but if you look at mid-cap stocks, they're about 17.5% times. Small cap stocks are 17.1 times. Those are reasonable valuation levels as we go back all the way to 2000. So party on, but stay sober, and you will be rewarded. I cut this the other day before Meta and Microsoft reported. By the way, had they missed their expectations, that could have been a bloodbath, I think, but they didn't, and that's good. So we get another leg higher based upon rising animal spirits in AI infrastructure. But if you look at large caps in the second half so far, they're up about 3%. Small caps are up 3.3%. And then mid caps are up about 3.7% or 3.8. So they're all clustered. But my point is, I don't think you have to chase the Mag 7. I don't think you have to chase the large caps. I think the stimulus that's being provided will provide uplift for other areas of the market as well. And I'm not alone. This was a headline from the Wall Street Journal this week saying that bargain stocks are drawing fans. Individuals seek alternatives to richly priced Mag 7 tech shares. So still bullish, but want you to remain sober-minded. So here's the bottom line. In terms of equities, I think they go higher in the second half. They already kind of have, so a little bit of a cheat there. But barring some sort of exogenous event, we're getting more trade deals. Tariff rates are coming down overall, and you have so much stimulus in the pipeline. The more people start peering into 2026, the more they're going to see the one big beautiful bill. And I think equities will go higher. In terms of size, I just like the mid caps. They are participating, the returns are there, and the valuations are much better. In terms of style, could see a rotation towards value. If you think about all the stimulus in the pipeline, that's good for financials, that's good for industrials, that's good for materials, it's good for energy. You think about all the build out that's necessary to power the AI, that's good for utilities. So I kind of like value. In terms of domicile, I would say the USA may catch a bid here. It's clear that the current Fed doesn't really want to cut interest rates. That should probably put a bid under that dollar. And now that we've gotten a little bit more clarity on the tariff issues, and again, we've got all this stimulus in the pipeline, which gives us a relative economic advantage, I think the dollar could go higher, which might return some of the favor back to the U.S. investors. In terms of U.S. interest rates, they're just going higher for longer. You can't have this much stimulus in the system and expect the 10-year Treasury to go back to 3.5%. Not going to happen. And in terms of bonds, we predicted investors will get 5%. They're going to get 5%. Feel pretty confident about that. Now, in terms of the primary threat, as we began the year, we said it's Trump going too fast, going too far, maybe getting off the cliff, and creating an air pocket within the markets who are trying to catch up. That indeed happened, but now I feel like the markets have caught up. I don't really think Trump's the primary threat anymore. As I've detailed, I think the primary threat is overly speculative activity as recognition in this huge amount of stimulus represented by my abominable snowman starts filtering into the system. We're already seeing it with economic surprise numbers ticking higher. You may anecdotally recognize it as you're talking to business owners who are getting bids or seeing revenues rise. I just think we're in sort of a frenzy area of the economy to come, and therefore the market nearer term. Just have to be vigilant, but we're staying on the line for now, just being more selective on it. That's a lot, I know. Thank you for letting me get that out of my head and into the screen, and I'd be happy at this point to talk further, take any questions.
Thanks, David. Great presentation as always. And we do have some time for some questions, and we did get a few, so I'm going to run through a few of those. We received a lot of questions related to Fed policy and interest rates. And as you mentioned, the Fed is now kind of taking their time on interest rates. But if the trajectory on interest rate policy is still lower, maybe it's just extended out a little bit, do you foresee a wall of cash entering the markets from investors, and how much of a catalyst could that be moving ahead?
There is still a lot of cash out there if you look at money markets, et cetera. And so, yes, if the Fed were to cut interest rates 1%, which they did this time last year, then your money market funds are going to go from, call it 4.25% to 3.25%. And then you're going to look at, the returns in the stock market or even returns in the bond market and feel like maybe that money would be better served elsewhere. So yeah, there is a positive flow effect from the Fed decreasing rates. Where the Fed policy gets a little bit sideways with Trump is even this morning, Trump was saying, what is too late doing? We got to get these mortgage rates down. Well, the last time the Fed cut interest rates was between September and December of last year. They cut them by a full percent. Mortgage rates went up by a full percent. So while the Fed may control the short end of the yield curve with policy, the marketplace controls the long end of the yield curve with economics, and that's what prices mortgages. So with this much stimulus in the system, I don't know how the mortgage rates end up coming down. And the last time the Fed cut rates, they actually went up. So Trump wants to blame high mortgage rates on Powell. I don't think that's necessarily true. And with all of this stimulus coming through, you can make an argument that Powell should be none and done for the year, that he shouldn't cut rates at all going into the end of the year as inflation sits where it is. So pressure on Powell to do something about the rate complex where it is. But the offset from stimulus means, I don't see longer term interest rates, which are more impactful within the economy, coming down. So even if Powell does cut rates, maybe pushes people into stocks a little bit more, which of course I would like, but I don't think it has an impact on long-term rates with this much stimulus in the pipeline.
Yeah. And so next question, you alluded to it a couple slides back on sort of our outlook for the second half, but it's expecting a stronger US dollar. So given that we received a few different questions related to currency, on the trajectory of the dollar, it's up almost 4% since the 1st of July. Do you see that trend continuing? And if so, from an allocation standpoint, as an investor, should I be thinking more U.S. domestic-based, investments as opposed to international?
Well, two ways to answer that. The first is sometimes there's just technical, cleansing that goes on in the market. So the short dollar trade was very crowded. And so there was pain to be had there, and the market figures out how to extract pain. So for those who are short the market, or the dollar down 10% on the year, there was sort of some comeuppance there. So that explains a little bit of the move. But if you think through classic economics, the first half of the year, the market or the dollar going down 10% while Trump's raising tariffs. And if you think about how that washes through, the dollar shouldn't really have gone down 10%, but Trump actually talked it down. And so going forward now, we've got tariffs somewhat stabilized. We have a lot of stimulus in the pipeline. That means that the economic growth rate in the US should continue to accelerate probably into next year. That means that long-term interest rates probably stay here, if not drift a little bit higher. And that's in comparison to Europe, which just reported barely any growth. I think Germany had a negative GDP growth print. And so you're going to get better yields in the US than you're going to get offshore. You're going to get more economic growth in the US than you're going to get offshore. You're going to get less tariff controversy in the back half of the year. I think the setup for the dollar is a little bit stronger, which we kind of thought in the beginning of the year, but then Trump being Trump figured out how to trump our forecast and talk the dollar down. I don't know that he's going to be able to do that in the second half of the year. So it'll be interesting to see how the tariff wash through. Fewer exports from the US, or more exports from the US, fewer imports from abroad is sort of what Trump's trying to accomplish with reindustrialization. So I think we're in an environment that supports the dollar here. But again, Trump can say something and talk it down. If the dollar does strengthen from here, it is better for US returns. And during the period you referenced, which is basically this month, US investments have been outperforming again. And if you look at what we invested in and sort of our fine tuning slice, if you will, we came back to the US a little bit. We got away from the Mag 7 into the mid caps, and then we bought industrials, and that trade has worked. I think it'll continue to work for the remainder of the year.
And you just mentioned in terms of Fed policy controlling the short end of the curve, markets will sort of dictate the long end of the curve. So this is kind of a compilation of a couple of different questions. With that, if the Fed does cut rates on the short end, how does the administration's position to reduce, sort of the issuance on the long end of the curve and issue on the short end of the curve affect overall market dynamics? And adding to that, what are your thoughts on sort of the long-term effects of that and increasing government debt over the next 5-10 years?
Yeah, so the quarterly refunding announcement came out yesterday, which was Bessent saying, here's how we're going to issue the bonds to mop up, previous expenses, because they do have a lag there. And they are concentrating on the short end of the yield curve. Now, consider this. There's insatiable demand for US Treasury bills. So those auctions don't fail, Yellen pushed more issuance to the short end. Bessent will likely push more issuance to the short end. Trump's talked about it because he recognizes that any interest rate cuts, as he said, too late, Powell could save us billions. What he meant was on short-term T-bills and the borrowing rate for the United States of America. So that is likely something that's structurally going to happen. Here's another thing that people haven't really talked about. So when you looked at the Genius Act that just passed, which put some parameters around stable coins, can't get into a whole discussion on stable coins, and I don't fully understand everything about stable coins, but I know this, they have to be backed by US Treasuries. So if we're going to take money out of savings, which is backed by kind of nothing, and move it into stable coins, you've just created another huge appetite for US Treasury bills. So I am not worried at all about there not being enough appetite for US Treasury debt. I think it's insatiable. And if you look at 4.4% as a 10-year Treasury yield, that is the demonstration of what the market thinks inflation is going to be plus GDP. That's right in line. Nothing about 4.4 suggests to me a buyer strike on US Treasuries. So we've created even more demand with stablecoins. Trump will rotate down towards T-bills. I think treasuries are fine and will continue to be, believe it or not, sort of the safety asset, at least in the bond market for the entire planet.
And we've got time, I think, for maybe one more question. We got a lot of questions on metals, David. So I think gold, silver, copper, all of those. You mentioned gold was the year-to-date leader as of June 30th in terms of return. Where do those go from here? Are they sniffing anything out from a sort of policy perspective or currency perspective?
For those of my clients who are on this call that are perennial gold bugs, you were right. So we don't typically hold gold as an asset class because it's not a stock, it's not a bond. We may hold gold miners because they are stocks periodically, but a metal is a metal is a metal. It's not a stock and it's not a bond. Now, it did occur to me one morning that central banks issue currency and they take the proceeds and they buy gold. So in a world of concern around currency dynamics, central banks have been buying a lot of gold. And because of that, and thanks to ubiquitous media, institutional investors, retail investors are aware of that. And that's helped bid up the price of gold. Now, gold is the anti-dollar. Typically, if you get a strengthening US dollar, you get a decrease in the value of gold. So that's something else to pay attention to. Furthermore, Bitcoin is being, promoted as digital gold. So there's some leakage probably out of gold as a safe haven into Bitcoin, and more sovereigns are taking that on. Obviously, we're seeing that in corporate treasuries too. So gold had a tremendous run spurred by central banks who said they wanted to own it in a world of crazy currency dynamics. Whether that run continues or not, I don't really know. But if the dollar strengthens, it puts a little bit of a headwind on that trade. Copper went down 25% yesterday, and that's because basically Trump cut tariffs on copper. The headlines say he reinforced the 50% tariff, but he also exempted copper that's been treated, which is most of the copper that we buy. So policy is still impacting the industrial metals a lot. I tend to think that trying to invest based upon government policy is a bit of a widowmaker, especially if you're trying to divine what Trump's going to do with tariffs for an individual metal or steel or aluminum or even countries like Canada or Mexico. So from the metals complex overall, I think the usage case is positive. There should be, in the reindustrialization, in the CapEx built out, more demand for the metals. As far as the run in gold, it's kind of gone sideways here for a little while. Copper got throttled by tariffs, which is a cautionary tale not to get over your skis in any of these individual commodities because they get pushed around so quickly. That's why traders like them, because they're volatile. It's a dangerous asset class. So right now, I'll stick with my stocks. The pathway there is clear.
That's a good point on the volatility of the metals. All right, that's all we have time for today. David, thank you. And thanks to everyone for joining us today. If you have questions, please don't hesitate to reach out to your WNA wealth strategist. And if you're not currently working with one, but would like to see how we can help or answer your questions, feel free to email us at request@wealthstrategists.com. We'd love to connect. Lastly, check out our website at wealthstrategists.com to subscribe to our weekly emails for more insights and updates like this.
Thank you, everybody, for tuning in for this hour. Obviously, it takes a lot more than an hour for us to prepare for this. Keeps the saw sharp, so it's a process I truly enjoy. So thanks to Matt and Nicole and Lainey and Karen and everybody who contributed to pulling this off today. And our goal in life is to enrich yours by providing clarity. I hope we did that today. Have a great summer, and if things change, we'll be back here with another live strategic insight. Otherwise, it'll be the outlook for 2026. Thank you very much, everyone.